today I saw a headline in the Business Day suggesting that Vine Capital is the preferred bidder for Afribank, and they will be paying as much as 45 billion for a controlling stake. And I compare that to the valuation of these banks right now. I saw Afribank today, the total market cap is somewhere around 26 billion. And to pay 45 billion doesn't sound right to me. What's your take on the numbers that are being bandied around right now? We know that the whole issue is still not in the public domain right now, but hopefully we'll get some clarity soon.
I think I'll be very surprised if Vine Capital, if they are the preferred bidder, are bidding up to 45 billion for a controlling stake. I think not only just on where the market cap of Afribank is now, but the actual position of the bank. I think 45 billion of pure equity into an institution like Afribank, getting your returns on that amount of equity is going to be very difficult.
But let's take a look at the appropriate way to value banks in this situation. Yes, they are distressed institutions, and obviously they will go with distressed valuations goes with that, as we are seeing on the market right now. But for a strategic investor like the likes of Vine Capital, as are being bandied around right now, how do they value these companies?
I think if you look at what AMCON's trying to do, which is take the NPLs off the balance sheet of these banks, and those NPLs for some of the banks were up to 80% of their loan book. So you can discount the risk-weighted assets for most of those banks, because once the NPLs are taken off, they're going to be quite low. So what most investors are looking at is deposit base and franchise value. The deposit base is a bit skewed at the moment because most of those rescue banks, because CBN sent in interim management, they have an implicit CBN guarantee. And because they have an implicit CBN guarantee, you're not sure if those depositors are still there because of the CBN guarantee or still there because of the brand of the whatever rescue bank it is. Then you look at franchise value. I hear some shareholders, existing shareholders, talking about there's a branch network, you already have employees, you have IT systems. Yes, you do, but there's no point having all those assets in a bank if you haven't got enough capital to actually run as a bank and get your license. So I think those are the kind of things that people like Vine Capital are juggling with. And that's why most of their bids are not for 100% of the banks, but for a controlling stake. So existing shareholders will still have part of the bank to reflect the value that's already existing in those banks.
Many of these strategic investors are expected to take controlling stakes, like you mentioned. Some numbers that I've heard are as much as 80% in these entities. And for one scenario that I've heard for a particular bank, where I have a situation where the core investor is going to invest about 30 billion into the bank, and he's going to get 85% equity, and he's going to get a bank with well over 100 branches. And if you compare that with the regulatory minimum for a fresh license of 25 billion, it seems like it's going pretty cheap in my view.
If you look at just those headline figures, you could argue that. But I think in valuation, no one ever agrees on the valuation, even until when the deal is done. As I think there are always going to be discrepancies between different views of valuation. Yes, you can look at an existing distressed bank that has branches, has staff, but then you have to look at some of their income figures, like look at their income statement. Are they generating enough income to cover their operating expenses? A lot of the rescue banks are not. So even if you take over these banks, the amount of investment you're going to pour into the banks to get the IT systems up to scratch, especially with IFRS coming in. IFRS reporting requires improved management information systems. And so things like that, they're going to invest into the bank. And then when you look at there's a lot of the financials, you see that their operating expenses are not covered at the moment. And most of the profits they've shown in the last year are release of provisions.
And finally, to what extent is market capitalization a factor here? Like I mentioned, Afribank is about 26 billion. So one imagines that if you're even going to buy the entire entity, you should be paying the market value. Is that an issue in Nigeria? Does that make sense for a market like Nigeria?
I think there are two things there. In market capitalization shows what the market says the capitalization is, but then you assume that the market is efficient. With the problems we had with the Nigerian Stock Exchange, with issues of allegations of price manipulation and other issues, you can argue the market is inefficient. So market capitalization is not a true reflection of a lot of those companies. Then again, when you're valuing companies, really what you're looking at is enterprise value. Enterprise value covers debt, preferred stock options, not just the share price. And AMCON taking most of the debt off these banks removes that from the equation. But I think when you start looking at the bottom line or what the banks are going concern in terms of can they cover their operating expenses, you will lower your valuation compared to the market capitalization.